Well, it's been an interesting week. Global markets have been on edge after the Bank of Japan signaled it may lift interest rates. That rare move pushed Japanese bond yields to their highest levels in years and sent warning shots through the global debt markets. Investors were caught off guard because they were usually borrowing cheap yen to invest elsewhere. And if Japan raises rates, that strategy becomes somewhat risky. All of this is feeding straight into the metals space. Well, financial analyst Lynette Zang joins me now. Lynette, thanks very much indeed for your time.
I'm very happy to be here, Devin. Thank you for having me.
Well, look, let's start with the Bank of Japan and what happened this week, all right? I mean, what do you think their latest signal tells us about the state of global bond markets? I hear you talk a lot about this earlier this week. And what does it mean for the wider stability of risk assets?
Well, I mean, bonds are the underpinning of the global financial system. And for years, I mean, Japan has been the leader in showing the world how to battle and lose in the deflationary front since they've been mired in sub-zero since really the 90s. And so what this is telling me is that there is a key unraveling that is occurring in the most important market in the world, the government bond market, that sovereign debt market. And you better be prepared for it because that's how money is created in this system. And so that means I anticipate a huge amount of printing coming out because, as you pointed out earlier, when the yen carry trade unravels, well, it hits bond markets, but it also hits stock markets and real estate markets and all of the markets because they're borrowing cheaper to try and get that other yield. So if they're not getting that pickup in yield, they have to unwind their position. But it's also impacting the U.S. bond market, which performed quite badly recently, all things considered. And we're seeing yields in Japan in the 2-year yield that goes back to 2008. What was happening in 2008? The system was dying. So this to me is definitely a shot across the bow. And I don't know how they're really going to quite stabilize everything yet. Just what, more money printing? And then what does that do to inflation? And then if that brings on more rapid inflation, what does that do to public confidence, which is the only thing that's really still holding this system together?
You got to add to that the upcoming Fed decision, right? So with the Fed decision coming up, how do you see U.S. interest rate expectations shaping metals in particularly gold and silver, which have been surging on rate cut speculation for some time now, hasn't it?
Well, it has, but you also have to understand that we're inside of a key structural shift that most people are not aware of. Because in the U.S., our market pricing has been guided by derivative contracts on as much gold and silver as they can create. There are no limitations on how much they can create if they don't ever have to come up with the physical. But this is a trend that actually started last year, January, when the Bank of England shipped over, and LBMA shipped over all of this physical metals, creating a shortage in European physical metals, which a lot of other countries then rushed to fill that void because it's almost the jig is up in terms of supply and demand. I mean, what I'm seeing with all of this, and it's not just the metals. What are they? What is gold and silver? Gold and silver are sound money, physical gold and silver, sound money that is above all governments and all central banks because it has the broadest base of demand since it's used in every single sector of the global economy. But when you can create these paper contracts, and I don't know what that level is now because it's quite opaque, but before it was as opaque as it is right now, for every 1 ounce of physical gold that exists on the planet, the Wall Street had created 62 1,000 digital ounces of gold, and that was before the central banks really got into the derivative market. So what we're seeing here with the rise in the metals is the end of this currency's life cycle and the transition from being priced in terms of paper contracts to being priced in true demand and supply fashion, which is what people are taught is what the markets are about, but that's not. I mean, they've all been financialized and turned into trading products, but that is unraveling. And that's what all of this is telling me. What's happening in Japan, I mean, there's only one way to fight deflation, and that's with inflation, and then they get what they want with the inflation. And now they've got to raise rates because there's only one way to fight inflation, and that's with deflation. And they're out of tools. All they have is this. That's all they have, as far as I can tell. Now, maybe they'll surprise me again, but...
It partly answers my next question. I mean, silver, for example, continues to outperform critical metals, and critical metals, rather, are tightening across the board, Lynette. Which commodities do you believe are entering the strongest demand cycle? And what should investors focus on next?
Yeah, I believe in when we're talking about commodities, for me, I've studied currencies and currency life cycles since 1987. And this is a currency life cycle issue. And the way that you know that what I'm saying is true, don't take my word for it. Who am I? You go to the Federal Reserve, the FRED, and you look at the purchasing power of the consumer dollar. And what you will see there is that we are near the end of it having any purchasing power left at all. 3 cents out of the original dollar, on its way to a big fat zero. So the commodities, sound money commodities, are critical. And that's, frankly, personally, I'm all in. Because I've been studying this on some level since I was about 10 years old. So I know there's not one doubt in my mind. I've lived through not as major a currency reset as we're about to go through because it was still in transitional form. But, I was there in 1965 when they took the silver out of the monetary system. And I was there in 1971 when Nixon took us completely off the gold standard. And, we're talking about government bonds, but what nobody really ever seems to talk about, although there's evidence, and I can send you all the links that you'd like to see. But in the 60s, there was a major run from global governments turning in dollars and pulling the gold out of the monetary system. And that was one big reason, only one reason, why President Nixon took us off the gold standard. But today, if you look at the charts on foreign ownership of our government bonds, what you see is that peaked in what year was that? Oh, yeah, 2008. And it has been steadily declining ever since. And when you put those two charts next to each other, because a shift away from U.S. government bonds is a run on the dollar. And so when you put those two charts right next to each other, they're almost identical. And so people don't realize it, but there's a major run on the dollar as foreign governments, and particularly Japan and China, which were the two biggest buyers of our government debt, have exited or are exiting this market.
And when you look at where that confidence is probably going, I found the latest CME report quite interesting, right? The report shows everyday investors piling into small gold and silver contracts at record levels. I mean, it was just released a few days ago. It's interesting that these are small contracts, not big banks or huge funds. What do you have to say about that?
Wow. I love that you brought up those small contracts, because really, when you're looking at it, the CME, which recently had a very inconvenient outage, but they continuously made the contracts on gold and silver smaller and smaller and smaller because they need new money coming in. But buying a contract on gold and silver, a futures contract, is not the same thing as holding physical in your hand. but it is a way for the markets to steer those that are buying into contracts which don't mean anything. And I will say, even though the markets are starting to recognize this now, and I mean, now I'm listening to Bloomberg or CNBC, and pretty much everybody or almost everybody that comes on is talking about, yes, you should have gold and silver in your portfolio. But think about this. Years ago, a couple years ago, Walmart, Amazon, and Costco started selling gold and silver. Now, they're not dealers. They're not buying anything back. They have no strategy. They don't understand it, but they know there was demand there. So quite honestly, this demand is not new. It's just now built up to a point where people are noticing it, and Wall Street's noticing it. They are definitely taking advantage of it in those contracts, but that goes back to what we were talking about to begin with, in that the contracts used to set the price, and they still do. I'm not saying that's over yet, but that transition has begun, and the fireworks are yet to be seen. Because frankly, even with the run in both gold and silver, neither one of them reflect the true fundamental value of an ounce of gold or an ounce of silver, which is substantially higher than it is right now. And that's where we're headed.
Interesting. Lynette, as I wrap up, let me ask you this. I mean, some analysts argue that the surge in retail buying is more emotion than fundamentals. You know, that silver's rise is being driven by hype and could unwind quickly. How do you respond to that view?
If it does, I say hallelujah, but I actually completely 100 bazillion% could not disagree with them more. And this is simply why. Because, look, this stuff people think of as money. This is also money. This is government debt-based fiat money that they inflate away. This is sound money that they cannot inflate away. So there's really a very simple formula for anybody that wants to know the true value of an ounce of gold and an ounce of silver. Since they're both money, they're just flip sides of the coin. How is this stuff created? It's created from debt. And since most countries, including the U.S., no longer publish how much new money they're creating, because we don't need to know that. I mean, that's just stinky information. So you can use all of the debt that's been created as a proxy for how much of this stuff has been printed in the world. With gold, there's a finite amount of it. So you take all the debt, you divide it by all the gold, and the Department of the Interior runs a report on an annual basis of how much gold and silver are yet in the ground, and you just divide all the debt by all the gold, and that gives you somewhere in the vicinity of $40,000. And then with silver, we have to remember that originally this little 1/20th of an ounce of gold that you can barely see in my fingers, between my fingers, this is a 1/20th of an ounce of gold, a $1 gold piece. This is a 1 ounce silver coin. So when you go to that ratio, 20-1, that puts the value of silver back at about somewhere around, I don't know, $2,000, $1,200, $2,000, something like that. So at $60 and at $4,500 or $4,200, wherever the spot contracts happen to be at the moment, it's a bargain. And if those contracts get manipulated down, it's a bigger bargain. It doesn't matter, because that's just Wall Street, and their job is to make money. So there's always going to be hype, and there's always going to be trading, because that's how they make their money. But keep in mind that a key difference between gold and silver is that gold is indestructible. Silver gets used up in production. So part of the reason why you're seeing this surge in silver, and silver at the moment absolutely outperforming gold on a short-term basis, is because this is a diminishing asset. That's also one of the reasons why it's not the primary currency metal that gold is, because we need this constant tool of measure, and we can account for about 98% of all the gold that's been mined. So there is a true supply and demand is starting to come back and matter again. Valuation matters, is beginning to matter again. And for most of the public, affordability. Oh, shocking. Affordability actually matters again too. What a concept.
Yeah. Now, always a pleasure, always insightful. Well, thanks very much indeed, Lynette Zang, financial analyst. It's been a pleasure speaking to you.
Always, anytime. Thank you for having me, and happy holidays.